following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
We are back. Let's talk futures. Joining us live is the chief economist of the CME Group, Erik Norland. Erik, good morning or afternoon, I guess, in your case.
Yeah, good afternoon from old Blighty here in England.
Wow, nice. Is the weather turned into spring yet?
We had a few spring-like days, but this week has been pretty wintry. We're down to highs in the low 50s, lows in the mid 30s. It's and gloomy. So short answer is no.
All right, and you're obviously talking Fahrenheit, even though you're in.
Yeah, that's right. Yeah, so yeah, we're talking Fahrenheit. Yeah, otherwise it would be like Dubai in the summer.
That's right. Well, so my imaginary script in my head for the interview, I kind of crumpled it up like a piece of paper and threw it away after this morning's GDP numbers seemed to have rocked both equities and the interest rate markets.
Yeah, that's right. I mean, the interest rate market had a choice as to what it could focus on. So two things came out of this number. First, growth was weaker than expected, which could be seen as being good for bonds. However, the core price number in the GDP report came in 0.3% higher. So it was expected at 3.4% annualized, came in at 3.7. The bond market would normally see that as bad, and the bond market chose to emphasize the sort of negative upside surprise on inflation versus what, from the bond market's perspective, might be a positive downside surprise on growth. So you're seeing bond yields kind of drifting higher. They've been kind of drifting maybe 6, 7, 8 basis points higher across the yield curve since that number came out. Now, for the stock market, the number is just purely bad. Less growth means less corporate profits. And now higher inflation and therefore higher yields means a higher discount rate being applied to future corporate earnings, which makes them worth less in the present moment. So the stock market's not happy. The futures are down, 1.5% to 2%, depending on which index you're looking at.
So why did everybody get it so wrong? I mean, everyone was, the banks included, were saying, headline 2 and over, and even, GDP now 2.7, and it was that big of a miss, I think.
Yeah, there were a couple things going on when you look at the details. So first of all, consumer spending was weaker than expected. When you look into the consumer spending data, consumption of manufactured goods or durable goods was actually negative in the quarter. It actually shrank at a 1% annualized pace. Consumption of non-durable goods, things like food, for example, was unchanged. It was flat. So that kind of held down consumption. Now, there was some good news. Services consumption was up 4%, which is very robust. But people were just generally not buying a lot of manufactured goods, and that kind of held down the number. The other thing that was going on was mainly on the trade side. And when you calculate GDP, you add exports and you subtract imports. And so exports grew at a fairly paltry 0.9%. Imports, which are subtracted, grew at a much more robust 7.2%. So it seems that the strength of the US dollar is kind of leading American consumers to buy a lot of goods from overseas, which is essentially like money out of the economy from the perspective of how GDP is calculated.
Yeah, and of course, we don't know where anything's manufactured. I go to Costco, I'm going to buy what I want to buy, and most likely it's coming from overseas, but that's kind of the result. I can get more.
Yeah, that's right. And so the kind of general message of it is Americans were buying less manufactured kinds of goods in general, but what they were buying tended to be more from foreign countries rather than domestically produced, at least insofar as the Bureau for Economic Analysis was able to calculate it for the first quarter when they produced this report.
So this is the first. They call it the advanced estimate. So we can call it the first estimate of Q1 for 2024, right? Meaning there's going to be another revision in 30 days.
Yeah, there'll be actually two revisions, one in 30 days and then another one in 60 days. And so what's kind of missing from this report so far is we don't have all of the trade data for the first quarter. So we'll be getting out more trade numbers for the month of March, and that'll add some, some variation into those import and export numbers. We'll also get more inventory numbers. We'll probably also get some revisions to the consumer spending numbers. And so there'll be a variety of things that go on inside of the report. We can also get revisions, maybe even to the price data a little bit. So if this isn't the final word, there will be two more revisions. But I would say the market generally doesn't react much to the revisions, unless for some reason they're really big, and that's extremely rare.
So could we learn anything about the upcoming PCE that's going to come out on Friday for within that personal income and outlays report?
Yeah, I mean, to me, it would suggest that there's a greater likelihood that it comes in above consensus. Since we had, generally speaking, higher inflation than was expected. We've seen this also in the CPI numbers that came out earlier this month. That also surprised 0.1% on the high side. This would suggest that the core PCE number is more likely than not to surprise the current consensus on the upside. Now, in traders' minds, they probably already adjusted for that. So when the actual number comes out, that doesn't necessarily mean the market's going to react. In fact, this may sort of quell any market reaction because it's sort of, giving away the punchline in advance.
I see. Okay, so that's interesting because my worry then is Friday, PCE is going to come in even worse than we expect the bad number to be.
That could be the case, but the thing is, the consensus is like a poll of economists that's already been taken, and so if the consensus were retaken right now, given the information we've had today, it would probably be revised upwards, and the bond traders know that. So, I think that the chances for a big reaction may be a little dampened by today's number.
Got it. Okay. Yeah. Treasury bonds. I'm an old school guy. I like to look at the 30-year Treasury bond just because that's where I came from, way back in the day. At 100, and it's still trading at a premium, 113,000 handle. Is there a chance we could go to a discount here? Ever get to the 99 print?
Well, what's interesting to me is when you look at the chart. When you kind of roll the futures forward, looking either at US1 or WN1, the ultra long bond, those markets have broken to new lows. So they actually broke through their previous lows. So that suggests to me we're kind of entering into either uncharted territory on the downside, or at least territory we haven't explored in a very, very long time. And that this is probably, kind of signaling that there's a possibility we could see bond yields kind of challenging the 5% level that we saw last fall. And we may see further upside in yields and therefore further downside in price. No guarantee of that, of course. If we get contrary data, if we get weak data, things could very easily go in reverse. But this market looks, to me, at least for the moment, like it still has some downward momentum.
Yeah, and I think the CME Group's 2-year micro yield is hitting 5.0 as we speak, still pretty inverted against the 10-year.
Yeah, that's right. Yeah, we're still seeing an inversion of the yield curve, which has been going on now for ages. It started, in like the third quarter of 2022. So we're now 18 months into a yield curve inversion, which is sending potentially quite bearish signs for the economy. But if you look at the lag time between the shape of the yield curve and subsequent changes in GDP, that lag time is around 2 years to 2.75 or to 2.5 years. So the fact that the economy is growing is not entirely surprising, but the fact that it's slowing down is also not surprising given that yield curve inversion.
Right. Okay. Well, we'll keep track of that. I mean, and these aren't the only markets moving, right? Equities are way off their peak earlier today. Gold is, railing like wheat. We can talk about wheat another time, but gold is railing like crazy. The metals seem to be in play here as well.
Yeah, that's right. I mean, I think that the metals are probably looking at a number of different things here that are interesting. So first of all, you have um, really big budget deficits in the U.S. and other countries. Running around 6.5% of GDP in the U.S., maybe 4% in other countries. Secondly, you have a lot of geopolitical uncertainty. It may lead some investors to think that certain central banks might buy gold to avoid using the US dollar. And on top of that, you have the possibility that the Fed and other central banks might hold interest rates too high for too long and then have to cut interest rates way more than the market currently prices, which isn't much. Market's pretty much depriced interest rate cuts. And so you kind of have a sort of trifecta of factors that make gold very interesting. And when you look at the gold options market, there's been a lot of buyers of call options on gold with tremendously high strike prices of around 3,000, 3,250, 3,500. So there's a lot of people who are kind of positioning themselves for the possibility of a really, really extreme upside move in the yellow metal.
Yeah, and those numbers to me are staggering, right? I mean, it took us forever to get over 2,000. and and then once we did, it was like, oh my gosh. Then we kept railing. The front month right now is trading at around 23.43, 40, something like that, as we speak. And yeah, we had a little bit of a retracement, but no end in sight on the upward trend, in my opinion.
Yeah, I mean, what's interesting to me about it is when you look at the last time the Fed went from raising rates to cutting rates. So for the end of 2018, going from the end of 2018 to say early 2020, the Fed funds future went from expecting rates to be around 3% to finally conceding that no, they're actually going to zero. During that time, gold rallied from 1,200 to almost $2,100 an ounce. So it was like an 80% up move. So the thing is, if the Fed say at 5.75 now, and sure they may hold rates high for longer than people had previously expected, but if they were to cut rates, not even all the way to zero, but maybe just more than what the market currently prices, which is not much. The market's pricing are ultimately going to come down to like 4.5%. The idea that you could have a similar percentage move in gold is not that outrageous. And if we did have a similar, upward move in gold like we had from the end of 2018 to mid 2020, that would put gold very much in the range of where some of these strike prices are on those call options.
Wow. Well, the CME Fed funds tool right now is confirming the fact that, hey, higher for longer is here to stay.
I don't know if it's here to stay, but it's here right now. And now what I would point out is if you look at Fed funds futures over, say, the last 12 months, you've seen a tremendous variety of expectations. What the terminal rate was like, it's a terminal rate, we mean like what the market thinks the Fed's going to be at in, say, like 2 years' time. Last May, people were saying that was 3%. Then by October, it was up to 5%. Then it came all the way back down towards 3% by the beginning of this year in January. Now we're back up at 5. So these market expectations are changing very, very rapidly. But just because they're drifting upwards now doesn't mean they're going to stay there. They could very easily flip again and start moving the other direction. And typically when those expectations move downwards, that's really, really positive for precious metals.
Yeah, interesting. And not to throw Blue Putnam under the bus, but we were talking last week, and he was saying, well, a 50 or 75 basis point move either way in interest rates, is it really going to make that much difference in the economy?
Yeah, it may not make that much difference for the economy, but it could make a big, big difference for markets because if you're a gold investor, you're basically buying a currency that pays zero interest. So anything that makes the US dollar look less attractive by comparison is potentially positive for gold, even if it's not really all that big in the grand scheme of things. But yeah, I mean, the thing is, when the Fed gets to cutting rates, they often cut rates way more than 50 basis points. If you look at the Fed's last several easing cycles going back to, say, like the mid 1980s, those easing cycles have often been 500 basis point eases. I don't think it'll necessarily be 500 basis points this time, but the idea that the Fed could cut 300 basis points or 400 basis points is very easy to imagine.
So until that cycle starts, though, is the story earnings? Is that the story?
Yeah, I mean, I think earnings are always a driver of stock prices, and up until recently, they've been fairly robust. But the thing is, earnings kind of cycle as a percentage of GDP. They've kind of ranged between anywhere from as little as 6% of gross domestic product to as high as like 11, 12, 13% of GDP. The issue for earnings right now is they're kind of near the very high end of that range. So the portion of the economy that is corporate earnings is very high, and there may not be a lot of space to grow that. Um, and so, if you have a downturn in the economy, that tends to shrink earnings because the economy is getting smaller. But then, in addition to that, earnings often fall as a portion of the economy, which is why when we have even fairly mild recessions like we had in, say, 2001, or even like the global financial crisis, I know is very traumatic, but the economy contracted only 4%, which is why you wind up with like a 50 or 60% down move in the equity market.
Okay. Well, we'll see. We'll see how it goes. I mean, we're having a couple big reports coming in after the close. We had Meta yesterday, Tesla before that. Speaking of Tesla, I did a little. I saw your video that you made, which was interesting about silver, platinum, palladium, and you even talked about catalytic converters. So last night I was Googling everything I could about catalytic converters and what those particular instruments need. And I came up with an interesting kind of fact here or stat. It seems like there's an awful lot of catalytic converters that are stolen from people's cars, and it has a little bit of a cyclical nature to it.
Yeah, that's right. I mean, I guess that the incentive to commit the crime would depend on how much the value of the metal, right? Now, I guess the bad news for anybody looking for that sort of line of very dishonest work is that palladium prices have fallen from $3,000 to an ounce to $900 an ounce. So the price has come down a lot, which means that the incentive to engage in what might be referred to as secondary supply in the metals market has decreased significantly.
Right, but from that device itself, that's very much a combustion engine device, right? The idea is to convert carbon monoxide into carbon dioxide, which ironically is not good anymore either, from the '70s EPA initiative. And with the electric cars, we don't need to have one of those devices.
Yeah, that's right. The electric cars don't emit any pollution at all in a direct sense. Now, of course, there may be pollution depending on what the ultimate electricity source is, but yeah, they have no need for catalytic converters and therefore a reduced need for platinum and palladium. Although some of the EVs do contain a little bit of platinum, I think, in the batteries or in other components of the car.
Yeah.
Yeah, but I think that the whole EV story is very positive for copper, somewhat positive for aluminum, but definitely not positive for palladium. It may be kind of neutral for platinum.
Okay, well, you mentioned copper. Let's talk about it. I mean, it's off to the races right now. As several days it's been rallying like crazy, and from what I could tell, it's the expectation of a lack of supply.
Yeah, that's right. So copper among the various metals has had the slowest growing supply over the last 30 years. Since 1994, copper supplies are up maybe like 150% in terms of mining output, which I know sounds like a lot, but it's a lot smaller than the gains we've seen from aluminum, from iron ore, from steel, and from a lot of other metals. Copper supplies are relatively tight. The supplies are fairly concentrated in certain countries like Chile, where the production is not particularly growing. And copper has this tremendous source of new demand with all the electric vehicle recharging stations. and to switch also to wind energy and other things that are very copper intensive. And also would add even AI figures into this, the electrical demand associated not just with electric vehicles, but also with powering AI is is also very high. Like a proper hyper advanced AI chip will use as much electricity as an entire household. So there's going to be a lot of demand for expanding utility networks over the next few decades, and that's been pretty helpful to copper, which has been the big outperformer among the industrial metals.
Yeah, and without wind and solar, that grid is going to need to be powered somehow.
Yeah, that's right. Yeah, and so wind and solar are a component of that. But whatever is fueling it, there needs to be a more robust grid if people are going to be plugging more and more vehicles into it, and if we're going to be using a lot of AI-like technologies that are very hungry for electricity as well.
I'll tell you, I drove in a Tesla Y Long, and it was the best ride I've ever had. Beautiful car. But my wife will let me buy one. So I'm sticking with what we have right now. So I also heard, Erik, that the UK though has kind of turned the corner on with wind. Like they're predominant producer of wind now.
Yeah, the UK has invested tremendously in wind, and a lot of it's offshore. So when you fly into London, for example, if you're coming over the North Sea from, say, Amsterdam or Brussels, especially if you're going to the city airport, you notice huge wind farms built out into the North Sea. There's also wind farms built on the west coast of the United Kingdom, facing the Atlantic Ocean and Ireland. There's a lot of wind that comes through here. Ireland doesn't stop it because there's no mountains in Ireland. So, it just comes straight across the Atlantic with nothing to impede it.
Okay, so that actually could be a pretty good solution if it continues.
Yeah, at least part of the solution. And, unfortunately, solar doesn't work so well here in the UK, where it's often quite gloomy.
Yeah, no, you got to be in Arizona or in, I guess, the Middle East maybe for that, right?
Yeah, or even Spain, Morocco. Yeah, there's a lot of places south of France, Italy, but up here it's not so obvious.
Yeah. Well, speaking of the Middle East, though, isn't, as an example, Saudi Arabia investing a lot in that transition because they got a ton of sun.
Yeah, that's right. They have a ton of sun, and they've got a lot of money to finance the transition. So they definitely have the resources to finance a lot of investment if they want to.
Yeah, well, that's forward thinking. I think that's probably pretty good. I mean, eventually their resource will be depleted. I don't know if you've seen a study that says, all right, Saudi Arabia is going to run out of oil in the year 2000 something, but it will eventually happen, right?
Yeah, it will eventually happen. I mean, it's not an inexhaustible supply. I think their supplies are still very, very large, and I don't have in my mind what the end date would be, but I don't think it would be for probably at least 3-4 decades. But it's not an infinite amount of time, and these are very old societies, and so old societies tend to plan way in advance.
Yeah. Yep. So in any event, we'll see how that all pans out. But you mentioned the energy, associated with some of these chips, right? These AI chips. What about the Bitcoin miners? Will they just give up if energy costs are too much?
I don't think they'll necessarily give up, but I think that within Bitcoin, there are some adjustment mechanisms that could probably reduce the number of calculations needed to create a new Bitcoin if the miners run into difficulty producing it. Generally speaking, the amount of difficulty is on a one-way path upwards, and that one-way path upwards is enhanced every time it has a halving, which it recently had, where it essentially becomes twice as difficult to mint a new coin. But there have been little dips in the number of calculations necessary in the past. But I do think there'll be a strong incentive on the part of Bitcoin miners to move to the areas that have the lowest cost electricity.
I see. Okay. And that the architects of this blockchain thought of that ahead of time and built it into the equation, right?
Yeah, in a sense. I mean, there's the Bitcoin algorithm basically sort of dictates how many new coins will be created per year, and so based on that sort of fundamental aspect of the equations, the amount of difficulty necessary to create a new coin, or the number of calculations, or the hash rate, as it's sometimes called, varies in function of that.
Got it. And I know we got about a little less than 2 minutes left. And I know we've been all over the map. That's my fault. But the sense seems to me, let's talk about the Euro FX versus the US dollar really quickly. It seems like we're going to start seeing some cuts out of Europe before in the US. Will that have a significant impact on that currency pair?
It might. I mean, we saw the euro go down through parity a little bit over a year ago, I think. And since then, it's been back above. But the thing is, it's kind of a circular problem. If the euro goes below parity, that might incentivize the European Central Bank to push back rate cuts, or to wait for the Fed, because they don't really seem to like seeing a weak currency.
I see. Okay. So that's going to be a factor in their decision-making process, maybe.
Yeah, I think it's going to be kind of a feedback loop. On the one hand, their economy's struggling, so from a growth perspective, they might want to cut rates. Additionally, inflation has been moderating, so that would also argue for cutting rates. On the other hand, if they cut rates a lot more quickly and a lot more deeply than the Fed, then that could cause the currency to fall, which would, in a sense, be inflationary, and also kind of hits them in their prestige, if you will. So I don't know. I think the jury's still out in terms of how quickly they're going to cut.
Okay. Well, we'll save that for our next conversation. We are getting close to the end here. Erik Norland, Chief Economist of the CME Group. Erik, you're all over the website, right? We can Google you on CME and see videos and other types of information.
That's right. Yeah.
Awesome. Yeah, I saw that last one on the catalytic converter on Instagram, of all places.
Yeah. Yeah, they show up in all sorts of unlikely places. Yeah.
That's awesome. Well, thanks for being here with me. Greatly appreciate talking to you today.
All right. Thank you.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.